Thanks for joining me on my market report. My name is Mike, and my market report is on mortgage rates. If you're new to the channel or my videos, you'll know that we do these daily videos on mortgage rates, what's impacting them on any given day. It could be something from the headline news, or it could be sentiment that's changing, or geopolitical, or economic data. A lot of different variables that could go into impacting mortgage rates on a daily basis. And from being somebody on the outside, most likely don't know what that might be. But we also may get data that come in that you would think would be good news, and we get a negative reaction. So we're here to kind of go over that with you guys, so that way you guys get a better understanding where the market's at, what's in the line of thinking for some of these investors and stuff that are impacting mortgage rates on a daily basis here. A little bit about myself is I am a loan officer. I do work with the national lender, so we can certainly help you guys out with your loan needs, whether if you're from you know, whether if you're looking to refinance or you're looking to purchase. We can certainly give you guys your pre-approval letters, as well as help you finance your next property. We lend in all 50 states, so we're available for any guys that might be out there in the U.S. here, of course. But anyway, in case if you guys got questions, please feel free to reach out. We're also can be used as a source for a lot of different things, from answering questions on mortgage rates or programs available out there. We're here to help you guys out. Without further ado, why don't we jump right into our report here. We'll start off with our economic data. Today is supposed to be the big day. We get our Bureau of Labor Statistics data for the jobs data this week. And we'll start off with the average earnings for the month over month, for the month of December. So in November, it was revised slightly from 0.3% increase month over month to 0.4% for the month of November. So we had a little bit more of a impact on November, which is good news. Forecast was kind of for a 0.4% increase, and it came in a little bit hotter at 0.6%. So good news that people are making a little bit more money in the month of December. Now here's the big data we've been looking for. Now November's data was revised slightly higher from 210,000 to 249,000. However, for the month of December, they were expecting 400,000 new jobs to be created, and it came in a much disappointing number at 199,000. Now, if we recall, they were expecting about 400,000 number also with the ADP that came in on Wednesday, and that came in much hotter at 800,000 new jobs created. However, this went the opposite. Instead of double the forecast, it came in half of the forecast. So this is obviously a very disappointing number that we're getting here on the non-farm payrolls here. However, if you look at the unemployment rate, it went from 4.2% with a forecast of 4.1% drop to 3.9%. So our unemployment rate still went down as a result. And even the labor participation rate, I did go online and kind of check that out. That did go up a little bit. So we got a little bit more in participation rate on there as well. Now, lastly, we got this average work week in hours for the month of December. So November was revised slightly from 34.8 down to 34.7. Forecast is supposed to maintain the old number at 34.8, or now an increase, but it did remain unchanged at 34.7. So something to look at, of course, the jobs data. It is a little confusing as to how you know how could it go with a higher participation rate, lower unemployment rate, but come in a much disappointing. So they're kind of thinking we're kind of maximizing. We're at the max capacity for jobs right now, even though we got about 10 million job openings out there, according to the data that we're seeing out there. But again, we'll have to kind of watch and see. Now, take a look at the mortgage-backed securities. Now, the jobs bad data, the bad numbers, you would think it would be positive for bonds. However, today we'll touch on that. We're off our worst levels of the day so far. We're down 30 basis points, but off a much lower basis. So if you look at low at 100.36, and we're currently at 100.63. Obviously, that's almost another 30 basis points. We were down, so we were down nearly 60 basis points, or half a point. But we did improve a little bit since then. So a lot of lenders are coming in with worse pricing, changing pricing. As you can see here, we had 12 reprices to the worst, but then we had 2 positive. So those people are probably repriced way down here may have come back and made it more positive after it rebounded a little bit, subsided a little bit here. So this is something we'll have to kind of keep our eye on. We haven't, ever since the whole Fed minutes came out, it really kind of set up things off in terms of the balance sheets reduction. That's kind of what, out of the blue, that kind of surprised the markets this week. And what you're kind of seeing is that the government is basically, or Fed is trying to go, basically talking about that they're looking at lowering their balance sheets. And what does that mean? Well, there's less. Typically, what the Fed would do is they would, when securities or mortgage-backed securities or Treasuries would mature, they would take that money and reinvest it back into it. But right now, they're talking about not even doing that. They're just going to let it mature and let it go fall off the books. So, and that's what they're kind of looking towards. Now, that's what they call their, I believe they call that passive, passive way of lowering the balance sheet. So they're just kind of letting the maturities fall off and then going from there, rather than flat out not purchasing. They're just going to go ahead and let them fall off. Now, of course, that since they've talked a little bit about that, and that could happen as soon as the rate hikes. The rate hikes, they said as soon as after one or two rate hikes this year, we could start seeing that take place as well. So you're looking at as soon as anywhere between March and June, potentially, because they should be wrapped up with a taper by March, and then from as soon as that happens, we could be looking at rate hikes. And right now, currently on the books, about 3, but there could be potentially even more as well, because initially on the dot plot it said 3 for this year and 3 for next year. So those are all items we have to kind of keep an eye on. So we got the trend is continuing with the rates, mortgage rates continuing to rise here as a result. As you can see here, here's how it looked like earlier in the day. Sorry about that, it's not coming up. All right, so you see how a big drop, we came way down here, right around 9 o'clock. Since 9 o'clock, it's been kind of subsiding a little bit, kind of improving a little bit. And this is 9 o'clock West Coast time here as a result. And right now we're just after, as you can see here, probably about 11:23 is kind of where we are right now. All right, let's take a look at Treasuries. Treasuries kind of doing something similar. They're off at their trying to get past about this level here. They're off their heights of the day. They're all the way up to 1.8. They touched off at 1.8 even. Right now they're currently just under 1.787 right now, which is just below this technical level right now as well. So we'll see if this technical level holds, because right now we haven't seen any caps form yet. They've been kind of free fall for mortgage-backed securities, or free fall, so to speak, for terms of Treasury yields, as they kind of reach new heights here, and we haven't quite yet seen the end in sight. So there's been a locking bias for the most part as a result. So hopefully we're starting to see that right now, but we'll have to wait and see what transpires here. All right, so we're getting towards the end here. We're going to take a look one last thing here, and that would be the conforming loan limit average, which is at 3.5 now, and then 30-year fixed, and the 15 years at 2.77. So we've been seeing those continue to rise. Again, these are national averages for conforming limits. They do have points built into them. And if you follow my videos, you would know that these rates, there's a lot of variables that go into a rate quote. So there's no one size fits all. If you guys want a rate quote, please feel free to reach out. We can certainly talk to you a little bit about what kind of rates are going on right now and what we can do for you folks. All right, folks, that's pretty much at the end of the video right now. If you guys like these videos, we greatly appreciate it. Help us out by smashing the like button and go ahead and share. That would help us out. We greatly appreciate that. If you guys got any questions whatsoever, please feel free to reach out. We're here to help you guys out as well. Thanks so much for your time, and we appreciate you watching us and your support. And we'll look forward to seeing you guys on Monday's video. Have a great rest of your day. Enjoy your weekend, and see you Monday. Bye-bye.